Buying a home is now 52% more expensive than renting the typical apartment. This is the worst affordability ever recorded in the 27 years that CBRE has collected this data. And this is putting housing affordability worse than the levels we saw in 2008, which was the previous peak at 33%. Now, you would think that rent payments and mortgage payments would trend roughly in line, but if you look back throughout history, you can see that it's never quite that simple. And in hindsight, the majority of this 2010 decade is looking rather affordable at this point. So what is causing the deterioration of affordability in the housing market? Well, the primary driver will be mortgage rates, because in a very short span of time, roughly 2 years, mortgage rates have jumped from approximately 3% to 8%. Taking into account mortgage rates, income, and housing prices, July of 2023 actually stood out as the least affordable month for the US housing of this century. And that's according to the Atlanta Fed's Home Ownership Affordability Monitor Index. If you take 100 as a baseline, the index value lower than 100 actually indicates that the median household income is insufficient to cover the annual cost of owning the median priced home. And that's with a housing cost greater than 30% of income. And then anything above 100 becomes a more affordable housing market. So you could see that there were times throughout history where the housing market became more affordable. Today, less than 70% of households have sufficient income just to cover the median priced home. And because of the recent surge that we saw in mortgage rates, the readings for August, September, and October are likely to be worse. Here's a wonderful chart that shows the 3 levers that actually can improve housing affordability. We have income, price, and mortgage rates. If we take 0 as a baseline, anything that goes above, or in other words, is a positive figure, that actually improves housing affordability year on year. Anything negative worsens housing affordability. And so you can see that over the last couple years, that housing prices combined with mortgage rates have dramatically impacted housing affordability. Incomes have gone up, but not substantially enough to offset it. Among these 3 components, mortgage rates are likely to have the largest short-term impact on affordability. Incomes generally rise, but they rise with inflation and they rise at a relatively slow pace. Housing prices tend to be sticky, but mortgage rates can be rather volatile, as we've recently seen. And if we were to in fact head into recession, it is likely that the mortgage rates can drop. Another potential pathway to improved housing affordability is if we enter a prolonged period during which increased home construction, so more inventory coming to the market, restrains house price growth. So it keeps housing prices at bay while incomes continue to rise. And this, of course, combined with low rates, is how national affordability improved in the 1990s. Now, this article goes on to say that the last time housing affordability was this strained, it was actually restored after the national house prices crashed by 27% from peak to trough between 2007 and 2012. And of course, they're referring to the great financial crisis. Most housing economists, however, do not expect a pullback of this magnitude. Unlike the years preceding the 2008 crash, the nation is not grappling with an excessive surplus of existing homes for sale. In fact, the national housing inventory levels are near historic lows. And of course, today's housing market is not plagued by the risky mortgages that we saw in 2008. Many of us understand that housing affordability is not looking good right now. Well, what does that mean for the housing market? What are we starting to see unfold? Well, according to Redfin, buyers are backing out. They are getting cold feet and they are canceling their contracts to the tune of 16.3%. That's nearly 1 in every 6 deals are canceling. And this is the highest rate that we saw in nearly a year. And I believe there are a few things that are actually taking place right now. Number 1 is that buyers may have been pre-approved a couple months ago. They went out, they started shopping, but now they are just entering into contract. They call their mortgage lender up and they realize rates have now gone up dramatically. And that may actually increase their payment, $300, $400, $500 a month. And that might be enough to scare somebody out of the market or put them on the sidelines because it was already expensive a few months ago. Now it's even more expensive. On top of that, it could put them in a situation where they no longer qualify to purchase that property. And then another thing I think is happening is that buyers are starting to be very critical of the properties they're purchasing. So let's say a buyer gets into contract, now they do all of their inspections. They do roof, they do home, they do pest, and they realize this property needs a new roof, it needs a new HVAC system, and those are very costly repairs. In addition to the rising cancellations, we're starting to see existing home sales plummet. This red line is the current level of existing home sales, which is now under 4 million units on an annual basis. And you can see just a couple short years ago, we were approaching 6 million transactions. This is the lowest level that we've seen since 2010. And aside from 2010, this is the lowest level that we've actually seen in 27 years. Probably the wildest part of all this is that home prices have not actually reflected the sales pressure. In fact, if you look at this chart here, prices have actually doubled relative to sales in the last 4 years. And oddly enough, this is the exact same setup that we saw unfold from 2004 to 2008, leading into the great financial crisis. Sadly, housing affordability may not improve dramatically here in the short term. According to Goldman Sachs strategists, they actually expect mortgage rates to remain elevated for the foreseeable future. They are forecasting that mortgage rates by the time we reach 2026 will be lower, but they're only going to be hovering just under about 6.5%. And they are warning that these sustained higher rates are going to have the most pronounced impact in 2024 on the housing turnover, meaning they anticipate less inventory coming to the market and fewer transactions. They believe that this has to do with mortgage rates jumping up in such a short period of time because almost 90% of homeowners today have rates that are 2% below the current national average, and over 60% of all homeowners have rates that are 4% below current rate. Needless to say, they expect the lock-in effect to push existing home sales even lower in the coming months and to limit any rebound next year. Now, on the plus side, this puts buyers in the driver's seat. In fact, with so few transactions happening, and they actually anticipate that we will see home prices decline only modestly going into the winter months before they potentially rebound going into 2024. So if you are a buyer in today's market, now is a time to negotiate